Nice. Nice. It's finally done. It's finally profitable. Look at this. Okay. Let me zoom in. 527 crores, March 2025. 351 crores, March 2024. It's finally profitable 2 years in a row. And if you're wondering what this is, let me just move in. First of all, Screener.com, we all love Screener.com. This is Eternal. Eternal's financials. Eternal, owns Zomato, Blinkit also. And for 2 years in a row, it's finally profitable. If you want to see this visually, let's go to sales and margins. Let me just move in here. Look at this. First of all, amazing growth. Zomato or Eternal, such a large size, is still growing a lot. That's great. You can see this right here. Negative, 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 negative. It's finally moving up. 6%. Non-profit, sorry, net profit margin, 4% OPM. And already declining. Okay. From what I've read, this decline is due to investments. Okay, planned investments. So this rise in profitability is not a one-off, but it would be funny if it was. Right? It would be funny if Zomato never returns to profitability. Sorry, Eternal. Eternal never returns to profitability. But I think it will. Sorry, not I, but people think it will. So if you look at the price, first of all, shout out to all the investors in Zomato who bought around the IPO stage. And then, they saw the price drop from like 136, 148 to 46, 48. But believe in the Pinder Goyal, believe in the team. And yeah, now probably having a nice profit. So shout out to all of them. And to celebrate Zomato's profitability, let's read. Okay, let's finally read something after a few years. We're going to read Eternal's latest investor presentations. So here we are. Let me slide this in. Boom. First of all, nice logo, very minimalist. Nice name, Eternal, very fancy. E, small e, very nice. So, one recurring theme in this investor presentation is that EBITDA across all the business segments is either positive or break even, almost positive. So let's go for that. First, different segments. We have Zomato. We all know Zomato. We all love Zomato. Blinkit. We all love Blinkit. Hyperpure. Hyperpure is their B2B business. So they're supplying food products to all the food ingredients restaurants. Then we have District, which is an app for going out. So you can make dining reservations, buying tickets to live events, etc. You can do that on District. Then we have Feeding India. Okay, so Feeding India is this non-government feeding program of Eternal. We can see this. Let me zoom in. 190 million meals till date served low income affordable schools. Amazing. It's really a really nice thing that Eternal is doing, and I hope they get recognition for that. So yeah, moving on to the investor presentation, I can see this. The gross order value rising, revenue growth amazing, even at such a large scale. Very nice. So first, moving on to Zomato, the core business, food delivery. Zomato, you can see gross order value, restaurant partners, delivery partners. You can all read growing very fast. And you can see one thing, one important thing here. You see this CAGR of 30% in gross order value is more than the CAGR of restaurant partners and delivery partners. So we can assume that the average order value, okay, order value per delivery partner and restaurant partner is increasing. That's very good. That's very good for the profitability. And I hope Right assumption. Next page, finally profitable. you know, EBITDA margins finally good. We can read in the notes given below, progress in profitability, result of incremental improvements in scale, efficiency, and durability. And yeah, investments in category creation now largely behind us. So, Eternal is now an established, very famous brand. In this page, we can see one thing. Can you see this? Customers with annual frequency order over 50. So, more and more repeating customers are coming to Zomato and Blinkit. Eternal as a whole, more and more repeating customers are coming, which means that they can now offer less discounts, less subsidies, and make more profits. Next page, Blinkit. Yeah, let me just slide this in. Blinkit, quick commerce app. Okay, the gross order value growth here is larger than Zomato, and some analysts predict and estimate that the gross order value is on par to surpass Zomato. So, very nice acquisition. And we can see here also tending towards profitability. And in the notes, you see adjusted EBITDA margin declined to 1.3%, primarily due to growth investments. So it's not a one-off, guys, but it would still be kind of funny if it was like a one-off. Next thing, District. That's the going out app. Now, I did not know about District. It's the first time of hearing of this. Let's read. This is their one of a kind destination going out experience app in India. Hmm. And it's actually profitable. Look at this. Their adjusted EBITDA. Adjusted. I don't know what it's adjusted for, but the gist is this is becoming more and more profitable. Very nice, very nice. Then we have Hyperpure, the B2B supplies business. Revenue growing, EBITDA also going more and more towards break even and profitability. So all this is really nice. And one question when I read this, and I'm sure is also on your mind, is why? Why is this company becoming more profitable? And so, in order to do that, I prepared a very small PPT explaining some of the reasons. Okay. So, why profits? All right. That's a good question. Why are they profitable? So, some of the reasons we have, and only some because I don't have all, and all these reasons I got from ChatGPT. So, thanks to ChatGPT. So, first, batching and route matching. Now, earlier, Zomato gets an order, right? Rider goes out to fill an order. Now, using AI, of course, artificial intelligence, it's everywhere. They're able to cluster orders by location. So a driver will now be able to have three orders delivered per ride, right? And because the locations are close to each other, the fuel cost increase will not be that much higher. So now, instead of 3 to 4 orders per hour, a driver can do 6 to 8 orders. That's a double in rider productivity. And of course, delivery costs per order will decline, as again, the revenue increase will be much faster than the fuel cost increase. The next point is shared fleets between food and Blinkit. Now, one pool of riders will serve both food and groceries, and now there'll be less driver idle time. So they are now going to spend more time working, less time idling. The impact is 20 to 30% drop in per rider downtime. Next reason, very important, platform fees. Yes. So Zomato, Blinkit, I believe they both introduced platform fees. They started around mid 2023. Platform fee, is basically you order food and it's another fee they slap on top of the other charges, 2 to 6 rupees per order. And in 2024, 83 crore rupees were generated from platform fees. And these are almost pure profit because the money needed to maintain these platform fees. See the app infrastructure, all the money needed to spend on introducing these platform fees is very low. So this is mostly profit. And because this was fiscal 2024, it's estimated that around 24% of the entire net profit will be, or sorry, would have been platform fee revenue. The next reason, advertising. You go on the app, you're looking for food. So restaurants would like their restaurants to come first, right? Their food to come first. So they pay Zomato. And this is becoming very significant. So these numbers are estimated again from ChatGPT. And so ad revenue is said to be 7 to 9% of total food delivery revenue based on the peer benchmarks like Swiggy, DoorDash. So it's estimated that in fiscal year 2024, not 25, 24, 500 to 700 crore rupees came from ad revenue. And this is mostly profit. Again, this is mostly profit. Zomato doesn't have to share this with anyone else. There's no delivery cost. There's no labor costs. So gross profit of 80 to 90%, estimated around 540 crores, 500-ish crores, the total thing. Again, a very important part for this. So the video is actually getting sloppy. My voice is getting sloppy. I apologize. One last thing, if you would like to see, is that let me just slide this. Let me just slide this. Boom. Oh, that's where is it? Yes, one last thing to see. Sorry, sorry, sorry. One last thing to see is that in this, if you go to the profit and loss section, right, you see this 637 crores. It's not enough to cover this 863 crore sum. If you're wondering what that is, that's the depreciation. So EBITDA is still not enough to cover depreciation. And what's actually covering this is their other income, right? This other income section. And if you're wondering what this other income is, so if we go in their annual report, fiscal year 2024, this is the other income. It's interest income on their financial assets. So they have bank deposits, eternal that is, they have debentures and bonds, they have government securities, and they have mutual funds which they have invested in. So majority of the other income is interest income, and a smaller portion is coming from net gain on mutual funds units. Sorry, mutual fund units. Now, from what I understand, these are not realized. So maybe they bought these mutual funds, right, as investments. They rose in value. They have not sold it, and the rise in value is recorded as this net gain. Still important, important. And I guess, yeah, that's it. Sorry, the video is a bit sloppy. I will try to make better videos. This is a very low effort kind of thing, good vibes. And I hope you like it. I hope you like it. Stay tuned for more videos. Obviously dislike the video and have a good life. See you again.